We'd like to invite you today to a conversation we're having with Don Simoneaux from Waterloo Capital and Bobby Russell from Strat Capital. And we're talking with these guys from Austin, Texas about alternative investments. And so what I'd like to do first is just ask Don Simoneaux to introduce himself and tell us a little bit about what his day-to-day looks like as head of alternative investments for Waterloo. And maybe I butchered that title, Don.
No, you did good, Ben. Thank you. So I'm Don Simoneaux. I'm Director of Alternative Investments for Waterloo Capital here in Texas, in Austin, I've been in the alternative investment space really for coming up on 18 years now. I started off with Cambridge Associates in Boston as a private equity analyst, working with large institutions and endowments, sourcing private equity and other alternative strategies. And been with Waterloo since our beginning in 2012, and really tried to build out our capabilities on that side. Working with guys like Bobby and other advisors on our platform to bring institutional quality alternative investments to our clients.
Excellent. I appreciate that. So I want to get started with some concepts broadly that a lot of people hear about and not as many people are invested in, at least not at the beginning targets for a registered investment advisor, people with, say, $250,000 of investable assets. Sometimes we hear a lot of buzzwords on the internet, or we do our own research or whatever you want to call it, and we hear about these things and we think, I got to be part of that. Yeah. If you could maybe give us a broad overview of the landscape of some of the alternative investments that Waterloo platform kind of gives investors access to through a registered investment advisor like Strategic Capital.
Sure. So, whenever I joined the retail space in 2012, kind of coming from the institutional side, where we worked with, large, $100+ million institutional allocators, the types of alternative investments that they would allocate to. These are private placement, limited partnerships, a lot of times with, no liquidity and 10+ year time horizons. A lot of those types of investments are just simply not appropriate for the average investor. When I joined Waterloo, I started to evaluate the available options for retail investors in the alternative space, and I really found a stark disparity between the quality of managers that was managing funds designed for individual investors versus institutional investors.
Sure.
So initially, we were working with large, sort of ultra high net worth families, and we were sourcing, the same institutional quality private equity, hedge fund, direct lending, private credit strategies, and bringing those institutional quality managers to our individual client families where it was appropriate, right? We always begin with a risk assessment and a financial plan to understand how we can incorporate these alternative investments for individual clients. And, in some cases, a lot of those institutional products made sense.
Sure.
And over the years, the quality of available opportunities for smaller retail clients, the $250,000 level, those have gotten better, right? So, the Reg D offerings that are registered either in sort of liquid alternative functions, either in sort of mutual funds or interval funds, a lot of those managers that were previously in the institutional side have come and actually raised dedicated products that are much more suitable for the individual client. And so we've tried to navigate the alternative space, trying to find both the more illiquid offerings that are going to be appropriate for some of our larger clients and some of the better products in the liquid alternative space or semi-liquid alternative space that are much more appropriate for, our maybe non-qualified purchaser clients.
Perfect. I'm glad you segued there because I think I want to get into the overall concept of just an accredited investor, a qualified investor, and there's multiple tiers there. If you can kind of walk us through that a little bit on the back of the idea that liquidity is incredibly important, especially in volatile markets, and alternative investments aren't necessarily built to be the most liquid vehicles. Can you talk a little bit about the tier of investing classification for alternative investments, in general, and then talk about the importance of liquidity and how it's changed over the last say, half a decade?
Yes, certainly. So the SEC has three designations for investors going into private placements. The highest tier is qualified purchaser. That's $5 million in investable assets, excluding the primary homestead. These types of products that are going to be QP products are going to be long-term illiquid investments. So think private equity, venture capital, even some types of hedge fund products, to where you need a certain threshold in this category, a $5 million threshold, to be able to access these products. The second tier is what's called a qualified client designation. That's $2.2 million in investable assets, excluding homestead. These are going to be sometimes semi-liquid products that a lot of times will have a carry component, to where there's a profit split between the underlying manager and the investor. A lot of times those can align incentives and be appropriate in that circumstance. And the lowest tier is accredited investor. That's going to be $1 million in net worth, excluding homestead, or there's an income component that differs between single or joint filing. But that's the lowest designation, and the progress on the types of investments in the accredited space have really come a long way. Private equity is inherently an illiquid asset class. If you think about the concept of private equity, buying a private company, improving operations, restructuring the balance sheet, and ultimately selling that company off several years later at a premium to what you purchased it for, that doesn't offer liquidity in that interim time frame. However, in the accredited space, there have been products that will combine investors into these fund structures and diversify out their holdings in a lot of these different alternative strategies, where you can get similar type of exposure to some of the more illiquid QP products, but in a more palatable wrapper. So there are certain funds like registered investment corporations or interval funds, where it might have an accredited investor designation associated with that. However, it does offer sort of semi-liquid, offerings. So where you can get, some sort of liquidity in a regular basis, in most cases quarterly.
Sure. Excellent. As far as evaluating risk appetite and suitability for clients, when you look at a platform like Waterloo and you say, okay, well, part of our platform is bringing alternative investments to those that are traditionally at the beginning or moderate phases of the registered investment advisory scale, right? So a lot of the clients that you guys are having probably an intake are between, let's say, $1 million and $10 million, right? And so a lot of those clients that will be coming into the fold at a platform like Waterloo might have their first exposure to alternative investments, at least in a regular investment way, when they come to a platform through, say, a strategic capital and come to a Waterloo platform. How do you guys look at risk appetite, and how do you evaluate that from a client by client basis as you intake those clients through a registered investment advisory?
Sure. So, the typical risk questionnaire that a lot of advisors use it kind of relies on this idea of max pain threshold, the idea of, how comfortable, you are with volatility. That type of risk questionnaire isn't necessarily appropriate when considering the nuanced aspects of a lot of alternative investment strategies, especially as it relates to illiquidity. So we have a specialized risk questionnaire that we use for our clients, which really helps us evaluate a client's comfort with, number one, investing in startup businesses. Private equity is inherently more risky than public stocks, for instance. So sure. So we want to make sure our client has a certain comfort level with the type of risk that we might be taking in a strategy like this. Secondly, we need to understand how comfortable they are with illiquidity, right? And so, as it relates to building out a plan for a client, we need to understand, are they a high earning individual that is socking a lot of money away into their retirement accounts? If they can withstand, some illiquid exposure in their portfolio, a lot of times we can target maybe a higher rate of return or more diversified, uncorrelated return stream. So it really is a collaborative process that we go through with our clients to make sure that, number one, they understand what they're investing in. We want to make sure our clients are fully educated in what we're recommending to them. And number two, that these types of investments are appropriate and actually fit within their overall portfolio construction.
Sure, for sure. I like to get into maybe a history lesson a little bit, and I think you're probably the best person in Texas to do it. The idea of the Gulf, being in an alternative investment, being in a position, whether it's geopolitically or just geographically, to be an alternative investment haven, so to speak.
Yeah.
Can you talk a little bit about that? Because oil and gas has been the de facto standard, aside from real estate, for alternative investment for the better part of, well over 100 years.
Sure.
Can we talk about that a little bit in regards to how rich the history of Austin or of Texas is in the alternative investment space?
Yeah, certainly. So, so you can really kind of think about private equity from a history perspective. Modern private equity, if you think about it in traditional fund structures, leverage buyouts, things like that really started in New York. A lot of the major investment banks in the early 80s with, some of the mergers and acquisitions that took place during that time period. A lot of it was fueled on debt and it was levered. And, it was sort of the burgeoning of that asset class there. At the same time, on the West Coast, we had sort of the Silicon Valley explosion of venture capital there, kind of precipitated by some of the offshoots from Stanford, kind of made Silicon Valley what it is. So you have the bi-coastal framework here of sort of the private equity and hedge funds on the East Coast and the venture capital on the West Coast. Austin has been long known as a tech haven, right? So we had IBM here since the 70s, Texas Instruments here around the same time frame, and then Dell sort of blowing up our tech scene in the 90s, going into the early 2000s, really attracted a lot of tech talent to Austin. Around that time frame, Austin Ventures, if you remember that firm, they began investing in the early 2000s, late 90s, early 2000s, and really helped create a institutional investment culture. They were really one of our first larger institutional venture firms here in Austin. And, since they have since wound down their operations, we have a lot of offshoots. So we have a lot of, smaller venture firms here in town that, are creating a really vibrant and active startup community. That's been great. And, I think just based on, the quality of living here in Austin, there's been a lot of larger firms that have relocated a large portion of their operations here in Austin. So, we do have the institutional, investors are located here. But on the other side, there are hundreds of billions of dollars that are managed out of Austin on the institutional allocator side. So we have Texas, University of Texas endowments located here in Austin, Texas Teachers Retirement Systems, Texas Employee Retirement Systems. There's just a ton of capital that's here in Austin. And so that attracts a lot of top tier firms on the alternative investment side to come to Austin to raise assets. And, we benefited from that, being able to get access to a lot of these groups coming through town. And, it's a relationship driven business. So we try to cast a wide net and meet as many groups as possible. And, when appropriate, bring those types of investments to our clients.
Sure. Can you actually go a little more in depth? I don't want you to, be at risk of alienating any of your relationships, but I mean, you're a pretty well entrenched individual here in the space, and just talking about the endowment funds that are there in Austin, and some of the large institutional investors that really find a home base there. Can you talk about how important relationship is in the alternative investment space? Because it's still, I mean, it's not burgeoning to institutional investors, but for the mainstream investor, it's just coming online now with mainstream applicability, I guess, for lack of a better term. Can you talk a little bit about how important relationship is there in the area?
Yeah, for sure. So, whenever we're working with a group, so we have a very detailed and in-depth due diligence process that we go through whenever we make a new allocation to a manager. It's the same process that I did when I was working with a $1 trillion consulting firm that we try to do here for our clients at Waterloo and for advisors like Strategic. But on the backside of that is really the relationships that we have to cultivate and develop to be able to find and gain access to these managers. So, the types of managers that we gravitate to are the managers that are capital constrained and operating in markets where they don't need a lot of additional capital. That's our benefit as being a smaller than institutional investor. Working with our client families we work with, is that we can allocate to strategies that that are limited in the amount of capital that they can take in to implement a given strategy. So some of a good example of it is there's some lending categories here in Texas that might source $100 to $300 million in new loans per year, and the funds that invest in this space can only deploy a certain amount of capital. And so there's a limited amount of spots that are available for investors to access these strategies. And so we will go out and develop relationships with what we feel like are the best managers in a given space. They can get comfortable with our due diligence process, our ability to operate and administer investments in this space. And ideally, we're able to negotiate either for lower fees or lower minimums for our clients to be able to access these strategies that really just aren't available at any other sort of similar size institution. So that's really a competitive edge that we have in this space.
For sure. And how much of your time, maybe you don't want to go into this, but how much of your time is spent actually nurturing those relationships? I mean, you must be sitting on board seats. You must be at meetings consistently.
Oh, sure. Yeah, I just spoke at an alternative investment conference last month, and we kind of do those things because it's a great way for us to continue to build these relationships, and it's a continual process, right? We're always trying to network and meet what we feel like are the best managers in the space, or an up and coming manager that will be one of the best managers in their particular strategy. And so it's something that we do all day, every day. Really trying to stay abreast of what's happening in the alternative investment space, and make relationships with top tier teams.
For sure. I want to change. Move in a different direction here for a few minutes and talk a little bit about kind of the cult of personality that's come along with alternative investments sometimes in its past. I want to mention guys like Carl Icahn in the 70s and 80s and guys like Bill Ackman today. Mm-hmm. How much of what's being said in sound bites for 3 minutes on CNBC is moving the alternative investments market? And how does that influence kind of what you guys are doing in the back office role? Even though you're a figurehead for
Sure.
Waterloo, you also maintain a back office role at some level. Can you talk a little bit about how that moves the markets or how that influences the way that you make decisions on a daily?
Yeah. So let's be clear. In the hedge fund space, one strategy within the hedge fund strategy buckets is activist investors, and it's the idea that a manager can take a position in a stock and then go public and speak their book. Carl Icahn's done this. Bill Ackman has absolutely done this. So they'll build in a position and they'll go to the public and say, "Oh, well, we think that, Herbalife, for instance, is, a fraud, they're a Ponzi scheme. So, we have a short position on it, and we're going to tell you why we have that short position. And it absolutely moves the market. Now, whether or not, the compliance around, what can be said and all of that gets a little complicated. So we won't go too in depth on that side, but the cult of personality is alive and well in the hedge fund space. These managers are calculated and know exactly what they need to say to move a position in their book. And that's what they're, the investors that invest in those funds pay them for. We've always had more of a focus, especially in the hedge fund side, of really trying to create diversified, uncorrelated strategies in that space. That's just kind of our philosophy when it comes to hedge fund investments. And we've kind of steered away from some of the, more verbose activist managers.
Is that mostly from a diversification perspective or a liquidity perspective, or is that a risk management?
It's risk management primarily for us, because a lot of these strategies are taking really concentrated positions in individual stocks and levering the fund against those positions. And so, the individual client, it's probably a lot of times maybe not appropriate for that level of risk that you might be taking in a fund like that, to where, you kind of look at, some of the large funds like Ackman's Pershing Square Fund. I think they had a great year last year. I think they were up, 20 to 30%. In previous years, they were down 20 to 30%. That sort of volatility might not be appropriate for an individual investor that, are really trying to, invest with, a shorter time horizon than you think about a perpetual institutional allocator. So, risk management is important. And, additionally, we're investing in manager skill in the alternative space. And, for us, we really try to incorporate a lot of these strategies into a diversified portfolio to allow our clients to earn higher risk-adjusted return and meet their objective, ideally with less risk over time. And that's how we think about the alternative space.
Sure. And as you vet those managers or those funds or those tools within the space, what is an appropriate timeline in your mind from a vetting perspective? How long do you look back, and what do you look at, when you're evaluating as someone who's bringing it to the masses, so to speak?
Sure. So our process really kind of starts on idea formation. So we do a lot of research. We publish a lot of research here at Waterloo. We just released our annual outlook. But we try to find certain areas of the market that we want exposure to. So over the last few years, we've been really active in private credit and direct lending, just kind of based on our bearish view of public bonds and, our anticipation of higher interest rates. And so, our thesis there was, okay, let's try to find, investments in private credit that might have a floating rate component, be backed by hard asset collateral, to where if we get a pop in interest rates, we're not going to be as affected from a valuation perspective. So like last year, public bonds were down. I think the aggregate bond index was down 13%. A lot of our, private credit strategies were up, 7 to 12%. That sort of outperformance, really kind of starts with, creating a thesis. So that's number one. Number two, we'll go out and, look across the market and try to evaluate, all right, what managers are implementing this strategy better than others. We have a few different ways that we can do that from a quantitative and qualitative perspective. We have initial meetings, we have conversations, we get access to data rooms. We'll go through and spend a lot of times 6 months getting comfortable with a manager.
Sure.
And then once we've gotten to the point, narrowed down our funnel to maybe 1 or 3 managers in a space, we'll go ahead and do a full due diligence. We'll go to the manager's office, really try to understand their strategy, back office operations. There's 2 different types of due diligence when you're thinking about private market. So you have your investment level due diligence, where you're trying to understand the strategy, looking at their track record, looking at the manager's background and their ability to replicate the strategy that they've implemented in the past. And secondly, there's operational due diligence that is just as important as investment level due diligence, to where we want to make sure the firm has the proper checks and procedures to administer the fund, protect client assets, and generally be able to execute the strategy from a business perspective.
Right.
And both of those are equally as important. And we spent a lot of time getting to understand exactly how these firms, how their business works. We'll write out our due diligence memorandum. We'll share that with our clients. And we spend a lot of time with our clients to really make sure they understand not only the firm that they're investing in, but the strategy, the managers, and how that fits in with their overall portfolio.
For sure. Let's talk a little bit about changes that have happened recently. In 2020, there were changes to the stipulations or the general guidelines for, let's say, accredited investors and above. But also there's been some changing, at least sound bites from guys like Gary Gensler and others who are on the public stage from a governmental or regulatory perspective. How have things changed in your view regarding, let's say, Reg D or private offerings on the back of this landscape of cryptocurrency and all these other things that are coming to market from a private placement perspective? Can you talk a little bit about some of that?
Yeah, sure. So, the crypto space is, kind of a different market right now. They're kind of in the midst of, looking at increased regulation there. We haven't recommended cryptocurrency to our clients from a fiduciary standpoint. Although we recommend, or we realize that, it might be appropriate to have some exposure there. However, we're not making a broad investment recommendation in that space. But as it relates to some of the changes, the Jobs Act really helped define exactly how accredited investor definitions, really changed. It allowed for, people that are licensed or registered as brokers to, become an accredited investor, and, also outlined individuals that have, demonstrable education or job experience that will qualify them as having professional knowledge. So it broadened out the definition of what accredited investors are. And we see that as a positive. We think broader access to the alternative investment space is welcome. However, we want to make sure, as a fiduciary and allocator, we want to make sure that our clients are only investing where appropriate. Appropriateness is something that, as an RIA, we take very seriously. We want to make sure that, the types of strategies that we're recommending fit within, our clients' long-term goals and objectives. If you look at sort of trends in the space recently, like groups like Blackstone have really entered the space, the retail space, very hard, kind of raising, tens of billions of dollars in the B-REIT platform. They're launching out some of their private credit strategies in the space, and also, what they're doing in, the private equity space as well. Those types of investments, could be appropriate. However, when you're investing in illiquid asset classes and trying to put it into a liquid wrapper, there can be, issues of liquidity. So I know B-REIT was in the news a lot over the last few months, gating investors based on the fact that they had more redemptions that they were allowed to send out. It didn't necessarily mean there was anything wrong with the assets, but the fact of the matter is, when you invest in commercial real estate buildings, these are inherently illiquid investments. And so matching liquidity with structural frameworks around some of these strategies is important. and that's something we look at whenever we're evaluating, some of these more retail focused products that have lower accreditation requirements. And so, that's a risk, just like, equity risk or interest rate risk. That's a risk that we have to account for. And so, even though that the market has gotten, a lot more open and, broaden out the definition for the types of investors that can go in, as an advisor, we always have to make sure, okay, they might be accredited now, but allocating to the strategy, is it appropriate?
Sure. I'm glad you brought up BREIT. BREIT's a popular institutional investment option for those that are into real estate investment trusts or have, as you said, defined a theory or
Sure.
a playbook that they want to go down. Talking about access to individual components and skewing towards the idea of using a platform like Waterloo through a strategic advisor like Strategic Capital in Austin. Can you talk a little bit about sufficiently de-risking pools of investments, or maybe can you just opine on the idea of whether there will ever be a day or a period in the market in alternative investments where ETFs or other tools are used to sufficiently de-risk whole portfolios for mainstream clients? Can you go down that channel for a little bit and talk?
Yeah, sure. Yeah. So, if you look at the way that institutions allocate, and, you can look at the evolution over time, kind of starting in the 60s and 70s when institutions were primarily, stock and bond investors. Throughout the late 70s and early 80s, a lot of those institutions started adding real estate as a broad allocation component to what they did. Going into the later 80s, early 90s, hedge funds and private equity became, a core part of what they did. And you look at today, the most sophisticated investors out there, which we feel are, the institutional allocators, have a lot of times 40 to 50% of their portfolio invested in.
Can I ask you a question along those lines real quick?
Sure.
I don't mean to cut you off, but you say the most sophisticated investors. Is this because the tooling and resources and back office support that they have while vetting investments? Or when you allude to that concept of sophistication from the institutional side, what specifically draws you to say something that way? I mean, clearly there's a lot of resources there to a major institutional investor. But
Absolutely.
Can you give some nuance to that?
Yeah, sure. So resources are a huge component to that. But, when you are a, $100 billion institution, the types of resources that you're able to bring to the forefront
Sure.
for your allocators are going to be unparalleled, right? They have access to the best data. They have access to a lot of times the best professionals with fantastic academic backgrounds to be able to go in and really look at their portfolio from an academic perspective to understand how correlations and estimated returns and volatility come together to create a portfolio that is really designed to meet the long-term objectives of that organization. If you think about a pension, your investment time horizon, is perpetual, right? You're investing for 100 plus years, and that really allows institutional allocators to think outside the box without having liquidity as a constraint to what they can do in their portfolios. Individual investors, they are constrained by liquidity. Ideally, the average families are, they're saving for, retirement that's, 30, 20, 10 years away. And, you have to solve for liquidity to make sure the cash will be available to meet the needs of the client. And so as we look at how institutional allocators allocate, they do have a heavier allocation to alternatives. And the retail investing community has come a long way in regard to alternative allocations. I think, REITs and private real estate, are now a component of more and more investors. There's a comfort there. People understand conceptually what they're owning and how they're earning income off of those types of investments. And while there's some correlation with the public markets with public and private real estate, it does provide a nice diversification component to portfolios. Does provide nice inflation protection, and so it can serve a very important part of portfolios. And other types of alternative strategies can play different roles in portfolio construction. We really try to define our alternatives to our clients into one of two categories: either return enhancing investments, thinking about investments that ideally will have a higher anticipated rate of return compared to public market investments. And secondly, risk reducing investments. These are either going to be lower volatility strategies, they're going to either be more stable income strategies, or just strategies that have less correlation with public market investments. And it's our job as an allocator to go through and determine what's an appropriate allocation to create a portfolio framework that's really designed to help our clients achieve their long-term goals, ideally with less risk, in a portfolio that has ample liquidity to be able to meet their needs. That's really all we're trying to solve for.
For sure. And I want to be clear to those that are listening, none of this constitutes investment advice. And even though we might talk about BREIT or other specific investments, this is not anything that should be misconstrued as advice from Don or Waterloo or Strategic Capital as to an individual investor. But I'd like to ask a question along those lines, and
okay.
You can stop me if it goes too far down.
Sure.
The rabbit hole here. But given the current environment of first quarter 2023 and the way that cash management and ultra short, resource management is playing out on the broader market, what are the types of conversations that you're having with your alternative investment clients who might be, I don't want to say reliant, because those that are in alternative investments generally have a stronger fortress built as far as total asset exposure. But what are the conversations you're having with people who might be looking to REIT investments or alternative investments as a risk hedge or a dividend payout relative to the way that the ultra short market is playing now?
Yeah, sure. So, the interest rates are really, core component to any sort of valuation or pricing model you look at. All assets are priced based on, some sort of spread compared to the risk-free rate, which, we consider as, the 2-year, treasury rate. So you can't get away from interest rates when we're thinking about, where we are allocating. And now, we have in our most recent outlook, we wrote something that said, we're shifting away from TINA to TERRA. By TINA, the idea is there is no alternative for, besides for investing in equity-related investments, because interest rates were so low, you weren't being compensated on a risk-adjusted or inflation-adjusted basis for investing in fixed income. Now, we're in a TERRA market, which means that there are reasonable alternatives to a lot of these more, equity-focused strategies. Treasuries now, across, different durations, can yield, 4.5%. That's a really nice rate of return, especially compared to where we saw, short duration interest rates a few years ago. As it relates to alternatives, we've been in the, private credit market and direct lending space. After the 2008 financial crisis, a lot of the types of lending that big banks used to do were eliminated from a regulatory basis due to Dodd-Frank and other regulatory laws like the Volcker rules that limited how banks were able to lend, especially in the middle market credit space, for instance. The alternative space really picked up that gap, and Today, we have, multiple investments that are in private credit strategies where we are targeting, 8 to 12% in, collateralized loans with a floating rate component. That's a really nice spread compared to even where interest rates are today.
Sure.
And, that's, I don't think what we're forecasting for interest rates to continue to rise like they have over the last 12 months, but
Right.
these types of strategies will give us some interest rate, protection to kind of diversify against higher rates. ESG has been a big buzzword in the alternative investment arena over the last few years, mainly driven by a lot of the institutional investors. Although, sustainable investing is becoming, much more top of mind for a lot of our clients. How do you invest, that, can benefit the overall, state of the world, either from environmental, social, or governance perspective. So, we looked at sort of decarbonization and renewable strategies where, we can get really nice income and have, some nice ESG effects that our clients appreciate there.
Sure.
And, in the, one of the bigger trends really is the access to alternatives. I know we talked about Blackstone, but they've done a lot to, build out strategies that, make a lot of these alternative investment categories more accessible. And there are a lot of managers in this space, and we look at them, for all of our clients. But, some of these private placements, Reg D strategies that, provide some liquidity, but, still give you exposure to either, private equity, private credit, or real estate investments. And so, that's been important for us to evaluate as the landscape's changed, and we'll continue to do that for our clients moving forward as the alternative market continues to evolve.
Great. Well, we've been talking with Bobby Russell from Strategic Capital in Austin, Texas, and primarily Don Simoneaux from Waterloo, also in Austin. And they're partnered together, and Waterloo's platform drives the investment specific component to Strategic Capital. Don, every time you talk, I feel like we've touched the tip of an iceberg. We could spend another 10 hours on talking about it. I look forward potentially to having some more discussions with you, but I want to give you the final word. And while this isn't intended as this audio track isn't intended necessarily as a pitch for Waterloo, give us a pitch for Waterloo. Tell us why Waterloo is the right partner at the right time.
Yeah, sure.
Who are in this space.
Waterloo, our goal really has been to bring institutional quality investment professionals to work with individual clients. And building that model over time, has really allowed us to attract extremely bright investment advisors like Bobby and the strategic team. And, they've allowed us to continue to scale out what we do here on the alternative investment side, as well as what we do in the public markets. But, as a registered investment advisor, it comes down to the fact that we are fiduciaries for our clients, that we always act in their best interests. And, a lot of times, we're able to bring really high quality institutional alternative investments to our clients in the most efficient way possible, and give them access to the highest quality investments. And so, that's a little bit about Waterloo, but I appreciate your time, Ben, and thanks for having me on.
Excellent. All right. On behalf of Bobby Russell, Don Simoneaux, Strategic Capital, and Waterloo, we'll talk to you soon.